In trading, knowledge is power, and lack of knowledge in what you're doing can be costly, very costly. So you need a solid foundation of quality market education. Whether you're new to trading or a seasoned veteran looking to add advanced strategies to your arsenal, there's always something to learn and something to improve on. And now you can access the same knowledge that professional traders receive with Market Rebellion's Trading Education. I'm Bill Johnson, Head of Options Education here at Market Rebellion, and we've assembled a comprehensive curriculum based on decades of real trading experience, covering everything you need to know about trading options from beginner to advanced. We go way beyond the nuts and bolts of options theory to teach you how to apply specific trading strategies and the techniques needed to adapt your trades when markets shift. Regardless of your goals, you'll gain access to the education you need with easy-to-consume lessons so you can learn to trade with confidence, enhance your knowledge, and master the practical skills required for market success. So please join us for in-depth trading education only from Market Rebellion. Hey, good afternoon once again, Market Rebels, and to all of our YouTubers out there. And Stu, it's that time again. Seems like Thursdays just roll around like so quick.
Every week.
It's time. They do roll around every week.
Yeah.
Time for Coach's Corner. And for anybody new, it's great having you here. Our reason for bringing this to you is to showcase some of our professional coaches here at Market Rebellion and to help you, some of the new traders out there, understand options, strategies, more about how to make decisions, and just understanding different ways to use options. And so today, that's what we're going to do. We actually, how did we close today, Stu? I think we were up almost 1%.
Just under 1%. Yeah, kind of across.
Just under 1%, was it?
Yeah.
But I think a lot of our moving averages, most of our majors are above the...
We are on top of whatever moving...
On top, yeah, like the 50 or whichever one was bumping up against last week. Yep.
Yep. Mm-hmm.
So I'll have to see. That's kind of looking good there. So for today, we have another topic for you. And it's a little bit of a carryover from last week, Stu, when we talked about selling a ratio spread, sometimes called a 1/-2, where you're buying an option and selling 2 at a higher strike call. Gives you an unlimited upside risk. But when we paired it with shares of stock, it greatly changed it. We found that in a way we were getting this added leverage for no out-of-pocket expense.
Yeah.
And so
bubble inside of the...
Yeah, exactly.
Up.
So we just started talking about it. We thought, there's really a lot of different ways and different strategies where we could do this, kind of mix and match and get different risk profiles that people are not used to seeing. So the theme last week was, again, a lot of traders would look at that ratio spread and say, I don't want to use it. It's got unlimited risk. I have no use for it. And that's really the wrong way to approach it, because you might be able to combine it with something else and make a perfect risk profile.
Yeah.
To meet your goals.
You know what the moral of that story is? Don't limit yourself to, I'm just going to buy a put. I'm just going to buy a call. I'm going to do a vertical spread. I mean, I get asked all the time, what's your favorite strategy? And my usual stock stupid answer is all of them, right? It just kind of depends on what I'm trying to do.
That's right.
An option is an option at the end of the day. It's just going to do whatever it's going to do. All these different names are just different combinations of different legs of options. And, you know, they don't really mean anything. They're just rights and obligations at different levels, different time periods.
Yep.
So, you know, don't ever limit yourself. Oh, I'm not going to do that. It's too much risk or not enough risk or, you know, whatever it is. You just think outside the box. You know, how can I add? How can I subtract? You know, what can I give myself a broken wing? You know, don't limit yourself. That's what I'm trying to say.
Yeah, we've always made the analogy that they're like tools in a toolbox. And the more tools you have, the more variations of things that you can accomplish. And that's really the best way to understand options. And that's what we're going to do today. So a little bit of a carryover from last week. And here's our Chalk Talk question for today. A little bit of a thought question for everyone out there. This is a straddle. Actually, it's called a short straddle. You're selling a call and a put, same expiration and same strike. And we're going to talk a little bit more about it in a moment. But right now, the question is, can you sell this straddle safely? Okay, so let's give it a good 5 or 10 seconds here. We want you to just think about it for a moment. And if you can picture that risk graph in your mind, picture it. Can you sell that safely?
Yeah. And think about it along the terms of what we're really saying here. Think outside the box.
Right. It's always a little bit of a trick question. So to kind of give you the answer, or at least our perspective on it, we want to show you about selling straddles against shares, how it can be done in at least somewhat of a safer manner. But notice that we're not just selling the straddle by itself. It's like we did last week where we were selling the ratio spread against shares, and that we can also do a similar thing with straddles.
Yeah.
And so we wanted to show this for traders because a lot of you are coming from a stock trading background, maybe starting to dabble in options, and you probably already have shares of stock. You're already comfortable holding
or
them.
are thinking about buying XYZ stock
or thinking about it. And then you've probably dabbled in some options and said, oh, I would never have a need for this short straddle. Well, hold that thought for a minute. Let's go find out. So let's start by talking about a straddle up front, just a regular long straddle. You're going to buy a call and a put with the same strike and the same expiration. And the idea behind the straddle is that you're going to make money whether the stock rises or falls. Now, notice I've highlighted far enough. And I know you know, Stu, but we hear this a lot from people. They'll say, join our webinar. We're going to show you the secret strategy that makes money whether the stock rises or falls. What other strategy would you need? Well, what they're not telling you is that it needs to rise or fall far enough.
Right. Because
it's not just
because the options are priced for an implied move. So
that's right.
If the stock actually in real life doesn't make that move, that straddle is going to lose if you're long it. You'll win if you're short it, but you'll lose if you're long it. If the stock makes a move outside of that implied move, which we measure on standard deviation basis, you might win. You probably will win, actually. Well, not guaranteed, but you know, if you trade it, you'll win.
Right. One of the other things that I always point out when you hear ads like that is you have to be careful if they say it makes money. It is true it makes money, but that's different from a profit. Just because either the call or the put is moving in the money, you could make an argument and say, well, one of them is making money.
Good.
But are they making enough money to offset the overall cost? That's the part that they usually leave out. So that's why it's important to understand it has to rise or fall far enough. Now, one of the downsides, really what I was just speaking about there, is that they have very wide break-even points because you are buying a call effectively for the cost of a call and a put. And you're buying a put effectively for the cost of a put and a call.
Yeah.
And the reason I say that is only one of those, at least at expiration, can make money, but you got to make up for two premiums.
Yeah, let's go over that really quick here. So if one's in the money, the other one has to be out of the money, right? Just think about this logically. If the other one's in the money, the other one has to be out of the money. So only one can be in the money at one time. And when you combine the prices of the two and you come up with a total, that means the stock has to be plus or minus that amount of money to, at the end, which is the expiration, break even. And then beyond that is where the profit could be.
Right. So if you think that it's hard enough to trade a call by itself or a put by itself,
in a way, you're trading a call or a put at 2 times the price.
Yeah, you're doubling.
It's kind of a way to think about it, and that's what causes the wide break evens.
Mm-hmm.
So, for anybody of you who might be new, we do have some great free content. marketrebellion.com/get started. We got, what do we have on there, Stu? We got lots of videos. There's PDFs. There's training courses. All kinds of stuff in there.
Keep track of it. There's so much.
I know. Always up. There's lots of stuff. So check that out. marketrebellion.com/get started. So here is our risk graph of a long straddle. Looks like a letter V. We get the bend right there at the strike. Remember, we have the same strikes, both at 100. Now we can also see we've got some wide break evens. If we paid 10 for the straddle, we need the stock to get above 100 plus 10,
right,
or 110, or below 100 minus 10 or 90. So yes, you can make money if the stock moves anywhere off of 100, but you're not making a profit until it moves past 110 or below 90. Well, that's a 10% move just to break even. And we've seen this a lot, Stu, with some of the tech earnings that come up. Why don't you tell people just very quickly a little bit about, I know you bring it up in Q&A, the implied move, how we can try to figure out where a stock is moving by looking at the at-the-money straddle.
Yeah. So what the market does is it takes a move and predicts a move into the future based on how the stock really has acted in the past. Right? A stock has a behavior, and every day that behavior is exhibited by what it is, right? Whatever it does, up 2, down 3, up 4, down 7, and over a period of time, it creates this behavioral type action that the market then takes and uses to kind of say, in the future, we think the stock is going to move this much money over a defined period of time. And that's your expiration. Could be 7 days, 14 days, a year, 4 years, whatever it is. So the market now takes that amount of movement and we plug it into the option pricing model, and out pops a price of that option, again, based on what the collective market thinks the stock could be moving over that defined period of time. And that's your price. That's the price of your option. That's not the cash. That's not the intrinsic. And really, in a long straddle that's at the money, there is no intrinsic. It's all extrinsic value. It's all the premium of the insurance to step away on either side. And collectively, when we put them together, it's called the straddle, and that's the implied move. So you could really, I guess I'm giving you a long-winded answer here, Bill, but you could really just take both numbers, add them together, say 5 and 5, that would be 10. And if it's $100 stock, 10 divided by 100 would be 10%. Right. And now the market is implying a 10% move. 10%. So when you hear everybody on CNBC saying, well, the earnings in Intel are due out tomorrow and they're expecting a 7.6% move, that's what they're talking about. They're just saying they're taking the at the money straddle, they're adding the numbers together and dividing it by the price of the stock. And that's the break even. And that's what the market is implying moving forward.
Yep. That's why they're willing to pay that price. Now, also, obviously, if you're between these break-even points at expiration, you've got some kind of a loss. Now, another thing to consider, a little side note here, a lot of times traders will look at this and say, wow, the maximum loss is 10. The chances for the stock to close at exactly 100.00 is pretty close to zero.
Kind of zero.
So chances, it's not zero, but it's pretty darn close.
Yeah.
A lot of times I'll just kind of just realize it's probably going to be somewhere less than that, but it can still be a very wide area where you're going to face losses. So this is where some traders get, thinking the straddle is the greatest thing because they can make money in either direction. You have to be careful of that interpretation. You need really big moves. And most of the time the market's pricing that in.
Or big enough to beat implied move.
To beat the implied move. Well, then that flips it. People say, well, okay, if it's really hard for the stock to get out of this center area here in jail, let's call it, well, maybe we should sell the straddle.
Yeah.
And we could do this. And now I'm going to make this gain if the stock stays in this very wide range.
Yeah.
Yeah, I've got unlimited losses theoretically, but that's probably not going to happen. And this is why a lot of traders, speculators, will short these things. This is also why a lot of people end up getting really hurt, thinking that a stock can't go from 100 to 220 in a short time.
Yeah, what's the key word in there? Probably, right? I mean, you got to live to trade another day, and if probably is going to put you out of business, it's probably not a good idea.
Yeah, not a good thing to do. So that was our question at the beginning. Traders look at this and they go, short straddle, short straddle, turn the page. I don't need it. And that's really the wrong way to approach it. As you mentioned, even for the long straddle, you could use it as a tool for trying to predict earnings or an FDA announcement. Well, how is the market expecting this to move? Yeah. Well, that's pretty good information. Doesn't mean you have to buy the straddle, but you need to understand it. So the question is, what's a set of conditions where we could sell this in a relatively safe fashion? That's our question. And before we go answer it, you know where to go, marketrebellion.com/get started.
So remember the premise what we started out with. We are willing to be owners of common stock.
That's what we're going to say that right now. That's going to be one of our goals here. We own 100 shares right now, and we're willing to buy 100 more. All right. Now, does this mean that's for everybody? Not at all. But there's a whole lot of people who currently own shares, might have a limit order, buy the stock if it hits 95 or below. They're absolutely ready, willing, and able to buy 100 more. Mm-hmm. Put that in red. That's something that you really need to be aware of to use this type of a strategy. Now, under these conditions, let's say that you sell that $100 straddle for 10. Well, now the question is, what does that risk graph look like? We saw it had that look like that upside down V, but just by adding 100 shares of stock, it's going to greatly change it. So what did we do here, Stu? Here's our long stock. At 100, we can see that's where we break even. That's our break even. That's our zero line. All right. So for anybody who might not be familiar with these graphs, these are profits up here above zero. These are losses. And right on that zero line is breaking even.
I don't know about you, Bill. When I see a straight line like that, I just get nervous.
It's fun. Not nervous on the way up, but on the way down, it is not fun. Of course. Exactly right.
On the way up, I kind of feel like the wolf is at the door, and on the way down, I'm just like,
it's true. It's still not all that comfortable on the way up because you're going, if we slide.
But that's me. That's why I'm an options guy, because I need that bend to help me sleep at night.
Absolutely. But the risk profile is showing us that if you buy stock at 100, or if you own it at a current price of 100 and it goes to 110, we trace a line up to that line and we look and, I'd be up 10. If it falls to 85, I'd be down 15. So it's just showing you what your profits or losses are at various stock prices. So we've got this in our account. Remember, that's part of our premise here. We already own the shares and we're willing to buy 100 more.
And I think you said this is 100 shares, right, Bill? Yeah.
This is 100. Yeah. And we're willing to buy 100. So we're going to sell one straddle.
All right. So you're selling
look at that.
And the put at the money, $100.
Yep. And Stu, this actually looks a little bit like a covered call, sort of.
How's that happen?
It's a problem. This is why you have to understand your deltas and what's going on and understand your strategies.
Or synthetics.
If we were to overlay, and your synthetics, if we were to overlay shares of stock with the sale of one call instead of a call and a put, which would be a true covered call, we would actually be here.
Or a synthetic short put, but
or synthetic short
put.
We're
also adding the short put as well.
So what's causing this? Why are we steeper down here, Stu? It looked like, when we looked at this, it looked like a covered call
on the right side.
But if we, even just the general shape, but when we overlay it with 100 shares in a call, it still has the same shape. It's just not as steep down here. What's going on? Why do we have? Well, we actually have 200 deltas here and zero.
Right, exactly. That's it. See, you have a more acute angle, and the more acute angle is because you have now double the shares. Right, you synthetically under the strike, you have synthetically 200 shares instead of 100 shares. So you're going to have a steeper angle, which means in English, if the stock goes down, you're going to get hammered twice as bad.
Twice as bad. Right. Now, some people might say, "Wait a minute, I don't have an extra 100 shares." No, but you took the obligation to buy them. And that in the financial side of that, it's just as good. It's going to create the same risk graph at expiration.
Yeah.
Just a question of you haven't actually paid for it yet.
I hear this all the time. Yeah, but I'm watching it. Yeah, what are you doing? You're watching it.
It's my favorite expression.
You're watching it gap down 10
watching it gap down 10 points.
Watching it trade down. What does that mean? Do you have a?
I don't know why people think that watching it. People think that watching it closely, if they can.
You have an obligation. That obligation exists, and once you hit the enter button and that order flies, you're in it to win it, or you're gonna, you can't control it. It's you have it, right? It's an obligation.
And anybody who thinks they can, and I know you've seen this many times on the floor, I've seen it as well, working in the retail side, but during the day, a stock can halt trading. Even sometimes traders who say, I don't want to hold overnight risk, let me be out by the close of business. Well, they've never experienced a stock halt. And what that means is you're sitting here staring at it, watching it really, really closely, and suddenly the numbers just freeze. And you're moving your mouse going, wait a minute, did my computer just freeze? Let me reboot. Nope. Suddenly it pops up on CNBC. It's halted. And that just means they that quickly stopped trading.
Yeah. That happened to me a number of times.
Oh, sure.
Stock, maybe some of you may remember it called Bank of Boston. I remember trading Bank of Boston. And I had a position. I was short gamma, and they put the goose eggs up. They put the zeros up, and I remember just taking my book and just dropping, saying, "Oh my God, I can't believe this is happening."
Oh yeah,
mercantile stores, Time Life. I mean, it happens. It just happens.
It does. Yep. Briex Minerals, and if anybody doesn't know that story, you can find the movie on YouTube. A fascinating story. I remember when that one got halted for like 3 days or 4 days. Mm-hmm. So they're not.
How about when the whole market got halted? Remember that, Bill?
Oh, sure. Yeah, you can have
about 21 years ago, a couple of days ago, right?
You can hit trading. You can hit trading curbs. That was about 4 or 5 days, three or 4 days plus a weekend. It was a long time.
The market was closed all week. I think what happened September 11th. Right, the market didn't open until the following week.
Right. So if you think that you're watching it closely and that means anything, it doesn't. It just means you don't understand how markets work. They can halt these things in a split second, and then suddenly it says, "Oh, the CEO was cooking the books and fled for Bolivia."
Yeah.
And now the next time they do open it, you'll say, "Oh, well, I'll just get out." Yes, you'll get out, but at 80 points lower, 80% off.
Yeah, that's the market. So, how come I got filled down there?
Yeah. So this is why you have to understand your option strategies. As Stu said, you want to get
obligation. That's all. That's all this is. It always comes back to that, Bill, doesn't it? A right?
It does. And rights and obligations. Yep. So you just want to make sure that you have these positions hedged before you step into the markets rather than after and saying, I'll watch it closely. Now, one thing that's interesting about this, notice that where these two curves cross, the red and the black, is 95. So they have the same break even. And that's because we have 100 shares with $5 or 200 shares with $10. Mm-hmm. So we still have the same break even. We do have an extra 100 deltas down here to the downside, but we're willing to assume that risk. That's why I put that in red. That's super important if you're going to use this as a strategy. Now that we're in it, what can we do?
You could take the credit money, buy a wing.
Well, you could. Let's hold that thought for a moment.
Okay.
But for right now, notice that the maximum gain, the red line sits quite a bit higher than the black. And that's because we took in 2 option premiums instead of 1. So one thing we can do here, which is what professional traders like to do, is what's called kind of a dynamic hedging or dynamic trading as things change. So what you could do is say, well, if I get assigned on the call, all right, we wave goodbye to the shares, we get assigned, we get called out, got exercised, whatever you want to call it, but you've now collected 2 times the amount of money.
Mm-hmm.
If you had just sold the call, you
extrinsic value from the call and the extrinsic value from the put.
Now you got it 2 times. Mm-hmm. However, if you get assigned on the put, which you were willing to do, rather than just selling the put, you also collected 2 times the amount of money.
You did.
And you also own 100 extra shares, but you were willing to own those. So from your perspective, you're going, wasn't really a big risk. I just collected the premiums. Now, once we have the 200 shares, what could we do? we could continue selling twice as many calls or 2 times calls until we get assigned and lose the shares.
Or we could sell one if we want.
Or we could sell one. Yeah, this is where it gets really fun, and we can start separating these strategies out. Now, Stu, I know we talk about this in Q&A sometimes of a systematic writing strategy.
Yeah, this is similar.
What else could we do here after, let's say we've lost those shares and we want to acquire 100 shares to start the process over? I started here assuming that you had 100 shares. What if we wanted to acquire them?
Well, you just kind of gave away the answer, Bill. I guess we could just sell the Strangle or sell the Straddle again and just look to get assigned and, get our 100 shares that way. If we sell the Straddle, then we're going to be short of call, short of put. If the stock, look, you have to say, I'm willing to own the shares, right? They got to take it away from you. So unless something changed in the world that you're not willing to own the shares anymore, then you wouldn't do it. But if you are, you could go ahead and sell the Straddle or sell the Straddle again. And if you get assigned, if you don't get assigned, let's start with that. If you don't get assigned, you just kind of collect all the premiums. If you do get assigned, you get to collect, you get to own the 100 shares on the put. You get to own the 100 shares and you collected the money on the call and you start all over again, right?
But
what you really do is, I guess you would sell, because you don't want to get assigned and be short, you would just sell the put. Just start over with selling the put. Get yourself assigned or look to get assigned or just keep the money from the sale. Well, I mean, keeping money is not a bad thing.
Right.
So, you could just get assigned and then now you start the systematic writing process. Then from there, you could sell the Straddle or sell the Strangle. And then from there, you can, you can write calls against the stock that you own. There's a myriad of alternatives that you can.
I think you were referring to, which we've talked about before. If you have a lot of shares, let's say 500, and you only sold 1 Straddle or 2 Straddles, and you still had shares, yes, you could sell the Straddle. I was assuming we've completely cleared out of our shares. That's what I was thinking. Just start out by selling a naked put.
Yeah, just sell the put.
Get your 100 shares. Mm-hmm. You keep selling it until you get assigned. And then what do? Now step back into this, step 2, and sell the Straddle, called a covered Straddle. And then if you get assigned, you've now accumulated all the shares that you want, and now sell calls until they go away, and then you start the process over. So we kind of did a systematic writing here just from starting in the middle by having shares and selling the Straddle.
You gotta be careful
the thing
with that term, it's out there all the time. Yes, it's right. Bill is 100% correct. It's called the covered Straddle. However, if you don't own the shares, it's
riskless. Yeah.
It's not covered. If you do own the shares, you're covered to the upside.
To the upside, yeah.
Right. But to the downside, you're not really covered.
You've doubled up the risk
on those shares. So but again, it's on the premise that you are willing to own an additional 100 shares. That comes from your obligation of selling the put alongside the obligation of selling the call as well. Right.
Now let's change it up. We were just talking about how versatile options are. Instead of selling the Straddle where we have the same strike, call, and put, what if we split them? That's a sister strategy called a Strangle. That's what you had mentioned before. Mm-hmm. What if we sold, instead of selling the 100 call and 100 put, what if we sell an out of the money put, the 95, and sell an out of the money call, the 105?
Yeah, I like that.
I do too. It's
better than the Straddle.
I would lean in this direction. I typically would too. Yeah.
Yeah.
Well, the question is, what does that do for our risk graph now?
Well, it's going to push that break even down a little bit because you got your obligation that's lower.
A little bit lower. Yep. But we're going to put this little angle. Notice that when we sell the Straddle, we only have one strike or one set of strikes to deal with. We've got the 100 call and put. So we only get one bend right there at 100. Now we have a 95 and a 105 strike, so we get 2 bends. So we have this area where we're not as profitable between 95 and 105, but we are now picking up the
you get the room, you got the capital appreciation.
You have some room for more capital appreciation, but you're also giving yourself a lower chance of being assigned,
which may go against your goal, right? Which kind of
might work. Right, exactly.
Well, look, you have to have a goal here, right? You have to have a goal. You got to start with something.
So important.
So tell me, let's sit down and have a conversation. Tell me what your goal is, and then let's work a system to achieve your goal. And then once you achieve your goal, don't get annoyed because your goal happened. I mean, that I see that all the time.
Every day.
Oh, you put some strategy together because you think the stock is going to 110 and it went to 110 and now you're annoyed.
You
Really?
got assigned, and then they say, "Oh, I got burned because it didn't go. I didn't get everything going exactly my way." So the main thing to show is that yes, you always have to have a goal. And one thing that's not a goal that we hear a lot is, I just want to make a lot of money. That is not. It's got to be defined. It's got to be measurable. That is not a goal. But for the right person, this could be a fabulous, I was going to say strategy, but it's really more a set of strategies based on what's happening in the markets. Yeah. And we just wanted to run that by you again, just to show you how a 1/-2 ratio spread, a lot of people would say, I have no use for that. Not true. Here's a case where you might say, I have no use for a short straddle. Not necessarily true. Depending on your goals, these could be fabulous, fabulous strategies that you cannot do with shares of stock.
No, you got it. But you have to, in order to like really make this work and be comfortable with it, you have to have an understanding of how options work, and you have to have an understanding of what to expect in the event of, and you could fill in the blank, which kind of brings you back to one of the things that we do here at Market Rebellion, which is help you to understand those concepts. You can make decisions that are not crazy, right? So you can make decisions about how you're going to live your financial life. Yep.
So we just wanted to run that by you. We hope that helped you to have a better understanding of options, some strategies, but the bigger picture is that don't shy away from some strategies that by themselves, in this case, a short straddle, might look like it's too risky and not right for you. Learn how to combine it with other strategies, in which what one comes to the top of my head is combine it with the strangle. What have we got? Got a butterfly, right? So some people might trade a butterfly. Well, we could separate it out as buying a strangle and then shorting a straddle.
Yeah, and it's
buying a longer dated strangle and selling lots of shorter dated straddles.
Right.
It just becomes crazy how many different strategies.
Go into condors, as break the wing, like I told.
Broken wings. Yep.
Last time, all kinds of way. They're just names. That's all they are. They're just names to describe how you put a strategy together. And at the end of it all, the options are just going to do what they're going to do anyway. So,
absolutely true. So now with that, Stu, let's see if we got some answers from our crowd here. So let's go back to our Chalk Talk question. We were short the 100 straddle for a total of 10. The question is, or at least these are the quotes, the question is, can you sell the straddle safely? What do you think? How did you answer this, Stu?
Maybe.
Yeah. My favorite answer when it comes to options is it depends. Even before I hear the question, I can probably tell you it depends. Yeah. So again, Bill, can you sell it by itself?
I could even make an argument. One of the things that I used to have to do was like get on stage and debate a topic when it came to options. And it was kind of fun because they would give you the topic, but they didn't tell you what side you were on.
Oh, I see. Interesting.
So you had to be ready to kind of go either way. Like I could go either way on this. I really could.
I could too. Of course.
You could even say, yeah, I'll sell it naked and it's safe, right? But it's all to what measure. It's all relative.
Statistically it is. Right. Yeah. But the thing is, in the long run, it will probably just take one to bury you. Because remember, based on fair value.
Yeah.
Yeah, you might be able to sell 10 straddles and completely keep the premium, but it's still priced fairly, which means in the long run, you're expected to break even. And that's something you always have to keep in mind. So we like to see people that can mix and match these strategies and create risk profiles that are better for you. So again, we hope that helped. Any closing thoughts there, Stu?
Yeah. My favorite line of all time, maybe one of my favorites.
I know where this is going.
Know your risk, people. Know your risk.
Absolutely.
Just know it. Know it inside and out. Don't let the market hand you something that you're not prepared for. And the only way to do that is to have an understanding of what the options will do as you
and when
can outline, a multitude of different outcomes.
Absolutely true. Well said. So we hope that helped everybody out there. And we want to wish everybody a great upcoming weekend. Stu, we got to see what's going to happen next week. I can't wait that we finally have poked up above these moving averages. We'll have to see if we can keep this little rally going. Yeah. But certainly going to be an interesting trading week, no matter what happens. Looking forward to it. And we will see all of you again next Thursday. We'll see you then.
Take care. Bye. See you. Thanks.